and welcome subscribers to the Saturday Summary for June 14th of 2014, your weekly summary of market and economic news for annuity and life insurance professionals. As always, I'm Jonathan Illig, Executive Sales Consultant for Brokers Alliance, here for the biz. Well, it was a relatively quiet week in the markets, putting sort of an exclamation point on the seemingly disconnected and complacent nature of market investors. It has really been the hallmark of 2014 to date. Now, in a week that saw Iraq erupt in flames and Hamas call for a new intifada against Israel, the price of oil hitting a 9-month high, U.S. consumer sentiment hitting a 3-month low, and both the International Monetary Fund and the Bank of America issuing warnings to expect real estate appreciation to slow significantly, plus the Bank of England telegraphing an interest rate increase soon, the broad indexes, while posting losses for the week, really did not react much. Gold reacted with an increase of over 2% this week, and the 10-year Treasury note yield closed the week at 2.61%, a welcome increase over last week, but that benchmark yield remains down over 13% year to date. Now, as we head into Father's Day weekend, the S&P has a year-to-date gain of 4.75%. The Dow is positive by 1.26%. The NASDAQ is positive 3.21%. And the Russell 2000 index is back in the red for 2014 by just a small margin. Now, at last week's summary, we showed you how the volatility index, or the VIX, got slammed lower in the final seconds before the markets closed. That was last Friday. And we shared with you that many professional pundits believe that the U.S. Fed was behind it, implying that the Fed is intervening to keep volatility low. Remember, when the VIX drops, the trading computers buy stocks and send prices up. Well, this Friday, something happened late day that illustrates just how hair-triggered the markets have become due to the majority of trading being conducted by these supercomputers that react only on algorithms that read not only prices but headlines as well. Now, as we see on this chart, on Friday at around 10:30 Eastern Time, the S&P 500, that's the green line, was on track to close down for the 4th day in a row, when the VIX, that's the red line, was sent lower. The VIX, remember, is inverted in this chart. Now, as expected, the trading computers sent the S&P 500 up, we can see that on the chart, till about 12:15, when a rumor circulated that the Prime Minister of Iraq had been killed, with a subsequent plunge in the S&P 500 index over a very short period of time. Well, about 15 minutes later, it was learned that this report was false. And as you can see at the far right edge of the chart, the S&P rallied back as the computers bought again to close the day with a gain of about 0.31%. Well, what's my point of this? With over 60% of the trading in the markets being executed by these high-frequency trading supercomputers, and again, they buy and sell with little to no human intervention, when a real trend or event occurs that starts to send markets down, the selling is likely to be fast and furious. Unless you're a day trader, it is unlikely you'll be able to get out in time. So to quote from one of the featured articles this week, when the tipping point comes, it will catch most investors, including many pros, by surprise. Well, no doubt next week will be interesting. Over the weekend, the situation in Iraq is going to continue to play out. Plus, next week, the Federal Open Market Committee is meeting, and there are rumors that they may announce a faster end to the quantitative easing or QE stimulus. Well, as we enjoy the weekend, complacency remains king in the financial markets, and trading volume remains very low. In fact, it's 50% below where it was 10 years ago. Now, from the March 09 low to the end of 2013, the S&P gained about 170%, but it's only done 4.75% in 2014 year to date. If you are nearing retirement or already retired, I would share with you this following analogy. If you were in a casino and you had a stake of $100 and you had to increase that $100 in order to afford to get home, and after several hours of gut-churning gambling, you had played that original $100 into $270. But you kept rolling the dice, but so far have only made another $4.75, and you know the odds are turning against you. Are you going to continue to risk losing a significant amount of what you've made so far for what is likely to be a very small additional gain, or is it time to take your money off the table? To quote the famous 20th century financier Bernard Baruch, when he was asked how he became wealthy, he replied, "I made my money by selling too soon." Well, anyway, moving on to the featured quote of the week, we're going to turn to Todd Harrison of the popular investing website Minionville, who wrote this week, "I don't believe zero interest rate policy or negative interest rate policy is normal, nor do I believe it is sustainable. Worse, I believe the imbalances it has created are cumulative and result in a most unpleasant comeuppance for anyone within spitting distance of the financial assets. And the fact that I'm so reticent to speak my mind and put this out there is perhaps the biggest single reason why I should. Well said, Mr. Harrison, and thank you for putting it out there. Well, that's your Saturday summary for Saturday, June 14th of 2014. Happy Father's Day to all, and to my father, thanks, Dad. And I finally quoted Bernard Baruch. That's a little inside joke. Thanks for joining us. We'll see you next Saturday.